This screencast is looking at autumn 2016, focusing on interest rate risk management. You can make sure you've read through the question. We're going to focus straight on Part B and Part C, which focus on interest rate risk management. So Part B is a very common question structure, both for foreign exchange risk but also interest rate risk, in that you're asked to assume that your IBOR, in this case, will be 2% higher or 2% lower than the current level for the next year, and for both scenarios show the cash flows associated with the 8 million loan. And they give you three different hedging alternatives, so either using a swap to manage your interest rate risk, using a collar, or doing nothing at all. And it's also important to make sure you read the question, particularly for these risk questions. There may be add-on requirements. It's not just running the numbers. You're also asked, based on this analysis and any other factors, that's important, advise whether they should manage the risk and how. So again, it's run the numbers, whether they should, number one, and how should they do it if they should. And it's both on the numbers but also any other relevant factors. So again, it is important that it's a bit of a broader question, and that could be worth 3 or 4 marks. So make sure you get those marks by answering all the sub-requirements. And finally then, it's a more narrative type piece for Part C. Critically assess, so that's important, the verb. You're looking for both positives there, and you're also looking for the negatives of the operation of the risk management function, and recommend 3 specific improvements. So there's 2 requirements here: critically assess, and then 3 improvements. So assuming you've read through the question, the broad background is this Bell company is a hotel company. It's bought a Danish hotel and it's funded it with a floating rate loan. So that means that it's a variable interest rate for €8 million of a loan. And they haven't hedged the loan or managed the risk for the interest rate movements to date. But now the FC, so the financial controller Jim Allen, is worried about interest rate rises, and he wants to, what you're told here, be prudent to hedge the interest rate exposure. And they're giving you 2 alternatives here: the swap and the interest rate collar. So again, we know the FC is in charge of all of this. They didn't decide to hedge it initially when they took out the loan, but now they feel it may be worthwhile to hedge the loan because they're feared that interest rates are rising. So again, as I mentioned before, this Part B is a very common structure to risk management questions. So you're given different scenarios and you're given different alternatives of how you might hedge the risk, both for foreign exchange and interest rate risk management. So I typically tell students to look at a 4-step approach, and this should do about 80 to 85% of all risk questions. The first one is to understand your position. That means in the Bell's case, what are they afraid of happening? So we know they have a loan, therefore they are afraid that the interest rate will rise. It did come up in 2015. They were given a deposit, and in that case you would have been afraid that interest rates would have fallen, because if you cash and deposit, you want a high interest rate. But in our case we have a loan, so we're afraid interest rates will rise. And also it's useful here for the background of the company. What is the risk aversion? So are they very afraid? And in this case, you know, the FC has told you they want to hedge it. So they don't want to be taking advantage of favourable movements, so that you're not really too worried about having an option where you may be able to get upside risk if it occurs. They're happy to hedge it out. So there's nothing particular there in terms of their request. The second step in terms of identifying the options, or you can call them alternatives, will be typically every question gives you a structure in terms of what scenarios are you going to run the numbers on. And we're told in our question we've 2 scenarios: 2% higher and 2% lower. And we also have 3 alternative hedging options. The 3 being do nothing, use a swap, or use a collar. So we know exactly the table that we need at the end. So sometimes I tell students your final table should look something like this: 2% higher, 2% lower, and you're then looking at the 3 alternatives, which is do nothing, use the swap, and use the collar. So it's useful at the outset to figure out, well, that's essentially the numbers I need to run. I need to get 6 figures to put in, depending on the 3 possible strategies I could use and the 2 scenarios I need to run the numbers under. Once you have those done, and I typically tell students skip a page, run those numbers in what I call an appendix, and then present them in a nice neat table, such as the one here, where you can make comments under. Typically what students will do otherwise is they'll do all the calculations straight away, and then they'll try and make comments underneath, but it's very hard to see what the final numbers should I say are for each option, so it's very hard to figure out what your commentary will be. Whereas if you keep a nice and neat table for your comments underneath, it's very clear then to see what the numbers are, and it gives you good discipline to remember to put in a narrative once you have the calculations done, because there's typically a couple of marks. So if we go back to our question, we have three different alternatives here. We have to use the swap, a collar, and do nothing. And one good piece of advice for students is always start with the easy one and work towards the hardest. The examiner here has put the swap the first one. A lot of students would have started with the swap, got caught up in it because it can be tricky, and never got to the very easy one down the end. So my advice is start with the easy one, which is typically the do nothing one. Then do the second hardest one, which I think is the interest rate collar. And finally, do the hardest one, which is the swap. That's the logic of that being that if you do get caught out and you don't get the swap finished, it's not the end of the world, and it won't have a domino effect on the rest of the question. So in this case, if we start with the do nothing, we have two different scenarios to look at. So we call them scenario 1, scenario 2. So imagine this is a new page, so we'll just bring it down so we have a bit of space. So we'll call it an appendix. And our do nothing one is literally we just take the interest rate that prevails in both scenarios. So here, Euribor. So Euribor currently, we're told in the question, is 2.5%. So scenario 1 says it'll be 2% higher, so it'll be 4.5%. And scenario 2 says it will be 2% lower, therefore it will be 0.5%. Because again, Euribor currently is 2.5. So based on those, we figure out, well, what interest would there be, net cash flows of the 8 million loan for the next year only. So just 1 year. So the interest on that loan for the next year would be 8 million times, and it's important to watch out here, you're not just paying Euribor, you're told in the question, and you should have it read before you looked at the screencast, it's Euribor plus a margin. And in this case the margin is 3.5%, therefore it'll be 4.5%, which is Euribor, plus 3.5%. So 8% overall. Meaning if we do nothing and the interest rate rises, which is the one Bell is afraid of, they're going to pay 640,000 in interest in year 1 or next year. The exact same logic for scenario 2, except now it's going to be 8 million times, we're still going to pay Euribor, so 0.035 plus, so the margin, apologies, I'm skipping ahead, 3.5 is the margin, and Euribor is 0.5%, so 0.005. So just be careful, it's 0.5%, that is 0.005. So in that case, if scenario 2, we'd only pay half that. So we're only paying 320,000 of interest, because again we're looking at a different scenario, that if the interest rate moves favorably, that it falls, then we will have a lot lower of an interest rate. But the key point there is it's very variable depending on how the interest rate swings. So we put that in, the do nothing one, the cost is 640 and 320. So it's useful about having that nice neat table at the end is you can fill it in as you go. And I might just, for the examiner's perspective, I'd reference their working one, for example, if it was on a different page. The next one I'm going to do is the collar, because I think that's the easier one than comparing to the swap. So the interest rate collar, remember what a collar is. A collar is essentially a combination of a cap, which limits how far the interest rate can rise, and a floor, which limits how low the interest rate can go. So in this case, Bell will buy a cap, because a cap is valuable if you have a loan, because it caps what the interest rate will be, and they will sell a floor. So a floor is obviously valuable to the bank, because the bank will have a minimum amount of interest rate. So in this case here, they have a collar, so the interest rate can go between 5% and 7%. So it can't go higher than 7, it can't go lower than 5. So that's what it means, you're in a collar within that 2% buffer zone. So if we look at here, the interest we calculate, if I can spell it, so the interest rate in scenario 1. So let's figure out what the interest rate will be. So we know it's Euribor, which is 4.5 plus 3.5. So the interest rate there is 8%. And without any cap, the interest rate for scenario 2 would be Euribor plus 3.5. So we know they would be paying 4% and 8% if we had no cap. However, or floor, should I say. However, with the collar, we would never pay 8% because we are capped out at 7. So there's a benefit there in the scenario 1 that we'd never get to 8% because we have a cap that we can use to say we should only ever pay a maximum of 7%. However, in scenario 2, we know we cannot go lower than 5% because that's what the floor is that we've agreed to. Therefore, the floor is going to mean we're going to pay a minimum of 5% interest. So if we calculate what that interest will be on 8 million, so it's 8 million times 7% in scenario 1, which is 560. So I'll just format these to make sure they look the same. And it's 8 million times 5%, which is 400,000 in scenario 2, where the interest rate has fallen. So again, what we can see here is there is still fluctuation, but it's not as big as the fluctuation for do nothing. But the other thing we have to look at here is remember to bring in your fees. When you do nothing, you have no transaction fees. So again, that's a pro of do nothing. But when you have a collar, we're going to have the cap fee, but we're going to have the floor income. So for both, you have to say how much the cap fee was. The premium for the cap fee was 0.3%. So 8 million times 0.003. So just be careful with your zeros there. However, we're going to get income from selling a floor, because remember, a floor is bad for us because it sets a minimum interest rate, so someone will be willing to pay for that, i.e. the bank. So in that case, it's going to be a minus because it reduces the payment we pay of 8 million times 0.0015. So the net impact is it's costing us 12 grand of a fee for the collar. So adding those up, we're at 572,000 for scenario 1. And remember, the fee will be the same regardless of which scenario, because it doesn't change depending on interest rates. It's a flat 3% or a flat 0.15%. So flat 0.3% or 0.15. So the total cash flows associated with scenario 2 then will be 412,000. So we can see, comparing here, the collar, in the worst case scenario we pay less interest, but in the good scenario we pay about 100 grand or 90 grand more interest than scenario 2. So there are pros and cons comparing and contrasting alternative 1 and 2. And don't forget to slot it in, 572 and 412. So, and I'll just cross-reference that, working 2. So now we've 2 of them done. So again, you have marks on the board, and now we'll try and tackle the hardest one, which is the swap. So my advice for students always when you're doing a swap is to draw it out. So if we look at here, we're told what the swap is. So Bell is going to pay a fixed rate of 5.5% to the bank, and the bank is going to pay Bell Euribor plus 3%. And then there's going to be a fee of 1% overall payable at the outset. So a lot of the time students can get confused in terms of who's paying what or what the net impact is overall. So I like to use a little diagram. Just it gets good practice, particularly initially when you're looking at swaps, try and explain what's going on. So the diagram will look something like this. You put your company here. They will have a loan already. Now again, this is just an example, so you can ignore the numbers. They will pay something with the swap. So this signifies the cash flow related to the swap. And they will get something in return. So in our case, we will have Bell as this company, and we will have the bank as the counterparty. and they'll be paying and transacting, but it's useful at the outset to actually try and explain it in a little diagram, even if it's just for study purposes, until you get more comfortable with dealing with interest rate swaps. So based on this, if we look at, for example, the Bell swap, well, what do they have? Well, Bell on their own, they have a normal floating rate loan of Euribor plus 3.5%. So we've dealt with that already. That's what they have on their own. They are going to pay the bank a fixed rate of 5.5%. So we're told that in the question. Bell will pay a fixed rate of 5.5 and receive Euribor plus 3%. So they're going to get back Euribor plus 3. And overall, the swap is going to result in a 1% fee. So the key point we want to figure out is, well, what's the net impact overall? What does that mean for Bell in terms of a net interest rate cost? And what essentially you have is what I've done down here. So don't be afraid to pause this now and make sure you can work through each of the steps. So the effective interest rate calculation. So Bell remember, the loan is separate to the swap. So you have to pay the interest on the loan, but you'll also have a separate arrangement, possibly with the same bank, or it could be with a different bank, to deal with the swap. So they pay the bank loan, which is Euribor plus 3.5%. So as Euribor goes up and down, Bell's interest rate goes up and down. However, with the swap, they're going to receive Euribor plus 3%. So they're going to get that in, that's why it's negative, and they're going to pay 5.5. So if we add them up, you can see straight away we're removing our interest rate risk because we're paying Euribor, but we're receiving it as well. The net impact is, because of having the swap, they've now locked in a fixed interest rate of 6%. Of course, that's excluding the fee. So the net overall will be a 7% interest cost. But the key point is there of how they've transformed a normal variable rate loan into a fixed rate loan by using a swap. And you can see the main reason is because they're paying out Euribor, but they're also now receiving Euribor, which cancels it out. So that's a very useful way of looking at it. You can see in the suggested solution in CAI, they go in each cash flow. So they say, what's the cash flow there? What's the cash flow for each of them? And they actually quantify it. I typically draw it out and figure out what the net interest rate cost is, which in this case is 6% plus a 1% fee. So for the swap then, for scenario 1, scenario 2, the net interest cost, so the net interest cost in both will be 6%. So it's 6% times 8 million. And it's the exact same for scenario 2. So remember, it doesn't matter here because it's always going to be 6%. That's what the interest rate swap does. It locks in the rate. And don't forget then you have a fee of 1%. So you have to include that because you have to compare the total cost for each option. So the fee there will be 8 million times 0.01. And of course the fee is the same for both scenarios. So overall the net cost will be 560 and 560. So giving you complete certainty as to what your interest rate cost will be. So just slot that in, 560 and 560. Reference there, working 3. So swap is probably the hardest one in that regard. So again, make sure you're comfortable enough with the workings here and try that for other ones as well. There are these diagrams are available for other questions on DoubleExit, so be free to download them and use them for the other interest rate questions that had swaps in them. So if we look at, that's the initial part of part B, is to figure out the cash flows, but now we want to answer here. So based on the analysis and any other relevant factors, which should be a guide, advise on whether they should manage it and how. So there's two separate questions there, so let's answer the first one first, is whether they should manage their interest rate risk. So we clearly see here from the question there's two important points. One is the one we've talked about already, that interest rates are going to rise. He believes they will rise, and he's worried about the interest rate exposure. So the first thing is, well, if you think there's a good chance of interest rate rising, it makes sense to try and manage that risk. Don't leave yourself exposed. We can see here there are massive swings depending on what scenario you're looking at, and more importantly in the question, this is a very important point. The total value of Bell's assets is 25 million. So if you have an 8 million loan, that 8 million loan, 8 over 25, is 32% of the value of your assets. So that's a very material amount, that if there's a swing in interest rates, you could have a material swing in your interest cost. So one clear justification for managing that risk is it's a material part of the business. So if that was only a 8 grand loan, you wouldn't be too worried about it. But because it's 8 million, it's a lot more important that you manage that risk and risk exposure. So it's clear we've answered the first one very deliberately, that we should, or Bell should, manage the risk. How they might do it? Well, we have 3 alternatives. The first one is obviously discounted, because we've already said they should not do nothing. So that one doesn't make sense. So now you're left with the swap, which gives you a guaranteed 560, or the collar, which gives you 572 or 412. In the broad scheme of things, it looks like the collar is probably the more effective one. Although it is slightly dearer here, it's very marginal. And that if there is interest rate, if it does go lower, or even if it doesn't go as high, you're likely to benefit from the collar, in the perspective that it does go from between 5 and 7%. So if it is lower than 7%, you can get that benefit. Whereas for the swap, you are locked in at a rate of 7%. So it does have a slightly different benefit for the collar. Yes, there is a small bit of a fee involved, but it looks, on the broad scheme of things, I would recommend to use the collar, because it gives you that flexibility. And even in the worst case scenario, it is only very marginally dearer than the swap alternative. So again, it's important that you make sure you cover the narrative element of the risk management questions as well as the calcs. The key point is here, if you want certainty, go with the swap. But in terms of a value for money option, the collar looks to be the better option, because it gives you that flexibility and potential upside risk, that if the interest rate happens to go lower, you can get that benefit. The final one is part C, is really around the actual process of risk management and whether it's good or bad in Bell. So you're looking for, well, what narrative am I given in the question that suggests what's going on with the risk management function. And you're typically looking around here. It's managed by the FC. Jim draws up all the risk management policy. All foreign exchange and interest rate risks are to be hedged. However, the FC, Jim, at his discretion, can choose whether or not to hedge any particular exposures, and they're all designed, implemented and monitored by the FC. So the key point is here, when you're told if a significant assets, revenues and costs denominated in foreign currencies, the risk management function is a critical part of the business. So overall, in terms of critically assessed, means look at the positives and negatives. Well, first, in terms of the positives, they do have a risk management policy, and they do recognize that it's a critical part of their business. So a lot of companies wouldn't even recognize that. So that is a first step that is positive. However, in terms of weaknesses, there is very much one dominant person, that there's no one else with the expertise, no one else involved in this. So if this person, for example, goes out sick, there's no one else left in charge. There doesn't seem to be any segregation of duties. And also in terms of, there seems to be a significant amount of control given to the FC. So if something happens, for example, they go rogue or they make a mistake and there's no second check, it could have significant consequences for the business, given that they have a significant amount of business in foreign currencies and borrowings, which obviously expose them to interest rate risk. So the fact that there's sole discretion of one person to make a decision whether or not to hedge particular exposures is probably too much power in one individual. So in terms of what you're asked for is 3 recommendations. Well, one is there should be more involvement, for going back to corporate governance, involving the board in terms of setting a risk management policy, being more prescriptive in terms of if a risk is over a certain amount, it must be hedged. And then being prescriptive in terms of how you assess which hedging mechanism to use, and perhaps involving the financial director, who is likely to be above the financial controller in the business, to sign off on the larger, more material risk management decisions. So the key point is here, you want to make sure there's more people involved to avoid one person having complete power over the decision making. And you also want to make sure there's a more formalized, prescriptive policy done at board level to kind of give an influence in terms of what the core policy is and at what level of risk this Bell company wants to take on in terms of foreign exchange risk and also interest rate risk. So that screencast looked at Autumn 16 question 3, focused on interest rate risk management.